So the Toronto area's housing market has done a complete 180 over the past 6 months. In March of this year, things were pretty competitive. Homes were selling quickly. Fast forward to today, and things are a lot slower. We're seeing far more for sale signs, far fewer sold signs. Homes and condos are getting far fewer showings. Inventories piling up. What is behind this relatively sudden shift in the market? That's what I'm going to be chatting about today. My name is John Pisalis. My team and I help buyers and sellers throughout the Toronto area make better real estate decisions. If you'd like to meet with me and my team, you can just click the link in the show notes below or send me an email at askjohn@movesmartly.com. So early this week, I had the pleasure of speaking actually at an event hosted by Bank of America. Once a year, they have what they call their Canada Banks Day, where many of their top clients come down. They speak with the top CEOs of Canada's banks. And the evening before that day, they host a private dinner and invite me to kind of be the sort of the main speaker talking about Canada's housing market. I've been doing this for, I don't know, maybe 6 or 7 years with them. And it's always great because they ask fantastic questions, which makes me think, which kind of prompted today's video. But also I get to hear what many of them are thinking, what they're worried about, some of the questions they ask. And of course, that shapes my thinking about the market and where I, think things might be going. And it, of course, influences my research and thoughts and analysis as well. So I'm going to kick things off today by looking at one of the questions they asked me, which I thought was pretty interesting, and unpack some of the feedback and insights that I got as well. But one of their first questions was, what has happened to Toronto's market over the past 6 months? And even though I've been talking about the market slowing down on our monthly roundtable and my live update, I haven't done a specific video trying to unpack and explain just why things have slowed down and what is behind this and what is happening. And of course, I can't offer concrete reasons for the motivations of buyers and sellers in the entire Toronto area. I mean, I can share some thoughts on what I think might be behind some of these trends just based on the ground anecdotes and observations that we hear. But again, I think it's helpful to also look at some numbers and stats to see, well, what is behind some of the dynamics we're looking at. So before we kick things off, I thought it'd be helpful to look at how things have changed over the past 6 months. And one way of doing that is by looking at what we call the months of inventory. And that's just a measure that actually measures the balance between supply and demand. We look at the number of homes available for sale. We divide that by the number of the sales over the past 30 days. And it tells us how quickly it would take the market to clear all the inventory if nothing else hit the market. So a market with 2 months of inventory is a pretty competitive market. A market with 6 months of inventory is a lot slower. Again, a lot more for sale signs rather than sold signs when you're at 6 months of inventory. So this next chart looks at the months of inventory on a weekly basis. I calculate it. It's a shorter time series. It's only from 2022 because I normally don't do this weekly. I mean, usually the market isn't changing that quickly to require doing this, but the market's been pretty volatile over the past little while, so I've been looking at it weekly. So if we look at that, the red line here shows us where we were at the end of March of this year. Low-rise houses in the dark blue had just 1.9 months of inventory. Condominiums, basically about 3 months of inventory. And since then, inventory has piled up. Low-rise is about 4.7, 4.8 months of inventory. And condominiums are just under 7 months of inventory. So what caused this change? What is behind these dynamics? Why did inventory start to pile up? Is it a sales factor? Is it dropping sales? Is it a surge in new listings? And if it is one of those, well, what might be behind that? So to better understand how things have evolved this year, what I wanted to do, or what I'm going to do, is basically compare the current sales and new listings volumes for each of the months or between January and August for 2024. And I'm going to compare them to their respective 10-year averages, the previous 10-year averages. And the idea here is to get a better understanding of how things this year compare to historical trends. And are we seeing a surge in one, or or sales plummeting? It just gives us an idea of how things have changed. And more importantly, it gives us an idea of how things have changed relative to historical norms between the start of the year versus the second half of the year, which is the other thing we're trying to understand. So it was the best way I can think of to sort of unpack some of these dynamics. So just to clarify, when we're doing this method, what it's basically saying is if we look at the chart and we see 0% for sales or new listings, what it's saying is for that given month, the sales volume or new listings volumes is in line with the 10-year average. It's exactly the same. If the measure is negative 20%, it means that month's sales or new listings volume is 20% below the 10-year average. And similarly, if it's plus 20%, it means that month's volumes is 20% above the 10-year average. So if we kick things off by looking at the stats for low-rise houses, so it's semi-detached and townhouses, we have sales in dark blue and new listings in red. And the one thing that stands out, of course, if we look at sales first, sales to start the year in January were just maybe about 12% below the 10-year average. And they started to plummet after that. And by March, they were down 35%. And for the rest of the year, they've been down 30 to 35%. So we started okay, and then things gradually got worse. And eventually, sales volumes are 30 to 35% below their historical trends. Now, when we look at new listings volumes for houses, they were also below their 10-year average. And in particular, between January to March, January, they were maybe about 17% below the 10-year average, 10% in February. By March, they were 26, 27% below the 10-year average. So even though sales were down, new listings were also soft, well below their average, which contributed to a relatively competitive market. But as we moved to the second half of the year, things changed. Not only were sales staying well below the historical trends, but new listings were inching up. And we can see on the chart, they're moving closer to their historical average. By July, we're actually slightly above the 10-year average for the month of July. So again, new listings volumes for houses are getting closer to what we would expect for their given year. So a little bit more typical, whereas the sales volumes were way below historical trends. So this is the big factor that has kind of contributed to this shift. So it's for houses, it's actually a combination of both. It's both sales declining after the first quarter, or even pretty much beginning in March of this year, but also and staying very soft for the entire kind of period since March, but also new listings volumes just gradually inching up and moving closer to where the historical volumes are. So if you have a historically normal level of new listings, but pretty much a 20-year low in sales, you're going to have more inventory. And that's generally what we're seeing right now. Inventory has picked up. Homes are selling not as quickly as they were in the past. They're sitting in the market a little bit longer. And again, I think it's a combination of these factors. So what might be behind these? The new listings, it's hard to explain. Like it's hard to explain why new listings volumes are so soft in the first quarter. I don't have a great explanation for that. The sales volumes, I think certainly part of it is just, I mean, from what we see on the ground, many buyers just waiting, quite frankly, for rates to be lower because they can't afford what they want at today's interest rates. They're hoping if rates drop more, they'll be able to spend a little bit more, borrow a little bit more, and get the house they want. So we do see a lot of people just waiting, sitting on the sidelines, specifically for that reason. But the other factor is when the market started to slow, it kind of pushed more people to the sidelines because, and we see this many of our clients, many clients who need to upsize when their current home, they're worried isn't going to sell, because what happens typically in Toronto is when people upsize, they buy their next home, then they sell their current home, because typically selling your home takes a week or so, whereas buying is pretty hard. Once there's a little bit more uncertainty about that sale, if they see that their neighbor's home isn't selling or it's going to take longer, they start worrying, well, what if my home doesn't sell? What if I don't get the price I want? And it basically pushes many of those buyers to the sidelines. They're in a bit of a holding pattern because they don't know what to do. They're anxious about taking the risk. So certainly we've seen more of those types of buyers move to the sideline a little bit, which is contributing to probably a little bit of softness in sales. So that's a little bit on the low-rise market. Now, if we kind of look at the condominium market, we see slightly different trends. I mean, the condominium market for sales actually, when we look at sales in blue, again, much like houses, they started 10%-ish below the 10-year average, gradually declined, but the decline in sales volumes for condominiums isn't as steep as houses, interestingly enough. And I think this is partly an affordability issue. Houses are significantly more expensive. By March, they did drop to just over 30%, picked up, the year-over-year decline in April was about 15%, and they did drop again in the second half of this year. So certainly part of the condo story is softer demand. The decline overall is not as soft as it was, between March and in August as it was for houses, but it's still soft. I mean, by June, July, August, we're over 35% down year over year. Sorry, not year over year, down from the 10-year average for condominiums sales volumes for those months. So soft sales coupled with relatively high volume of new listings. New listings pretty much for the entire year, aside from March, were, well above the historical average. And I think what's happening here is just gradually over time, inventory just started to pile up. Again, March was pretty much in line with historical averages with the 10-year average, but after that, things accelerated. So we saw condo listings gradually kind of start to accumulate as sales remain soft, and new listings picked up quite a bit and well above historical trends. So what's behind this? We kind of talked about this. The demand side is very similar to what we're seeing for houses, both affordability, people waiting on the sidelines, so rates are lower, people stuck, they can't upsize. And far fewer investors buying, which is slightly different from houses. The new listing side, we're definitely seeing more investors want to exit, more investors want to sell. In some cases, they have multiple properties. They want to take some money off the table. They're renewing their mortgage. They don't like the rate. They renew, but they just rather, just basically move on and try to sell it. And that has contributed to the spike in new listings that we've seen over the past little while. So that's a little bit about the dynamics, of course. Now, the question, of course, is where will things be in the months ahead? Impossible to predict. Again, I think it's hard to say where things are going to be going over the next couple months. We'll see how things evolve. I think, as I mentioned in my last video, that my instinct is that the market in the new year will be busier. I talked about this in the dinner that I did with the Bank of Canada. Most people seem to kind of tend to agree with that. And again, part of this is driven by we're going to have probably another 4 Bank of Canada rate cuts between now and the start of the spring market. So rates will be lower if we have rates in the 3% range. If we have, again, the Government of Canada's changes to mortgage rules as a stimulative policy, we'll probably see a little bit more demand hit the market. And again, I don't think it's going to be a crazy, unbelievably competitive market. I would be quite surprised. But, again, I think when we think about the outlook, I think the important thing is just to think about the balance of probability, what is most likely to happen. And I think the most likely path is maybe prices stay flat, maybe prices tick up a little bit. I think it's less likely that prices are crashing. And I think this is certainly a narrative we see a lot on social media platforms, because I think that the doom and gloom tends to get more clicks and be a little bit more buzzy. But that's something that kind of roughly came up in the discussion as well. And it was very interesting to hear many of the people in the banking industry not really concerned. Like, a lot of people, I think, on social media think the market's going to tank because people cannot afford their mortgage payments when their renewal comes up. They're going to be forced to sell. There's going to be tons of distress. It's going to flood the market with listings. And what I was hearing from people in the industry is that they're actually not particularly concerned. And in fact, that households are actually managing higher interest rates way better than they thought, quite frankly. And, they see this, of course, in arrears and not so much in mortgages, but even in unsecured debt. So the mood was not panic that the household, the Canadian household cannot manage this. They're kind of piling up debt and are back on all of their debt payments and things are getting worse. Most of it worse, things are better than we thought, and we're trying to figure out why they're better than we thought, especially with unemployment picking up a little bit, which I thought was very interesting. And even the idea of mortgage people coming up with mortgages resetting the new year. Of course, that was in the press a lot. People panicking, mortgage payments going to skyrocket. Again, the sentiment was, yeah, payments are going to go up, but if they go up, $400 or $500 a month for the average household, what they anticipate is happening is people are just going to keep paying their mortgages. They're just going to spend a little bit less, which is an issue, of course, for the Canadian economy. People are going to just start going out to fewer dinners. It's going to impact some sectors of the economy. It's going to impact the GDP, but not necessarily leads to this surge in defaults and listings of distressed households. It seemed like this was not on anyone's mind or radar. So I thought that was also an interesting perspective. Now, I'll finish off by saying, I mean, one interesting moment, I think one person in the dinner, we're sitting after more socially, the sort of after the whole talk and presentation issues right by me, and she said something like, I want to call you out on something. I'm like, knock yourself out, go for it. And she was basically talking about how in one of the previous dinners, I don't know if it was a year or two ago or something like that, she said I was kind of generally far more bearish and pessimistic, in particular for the pre-construction condos. And for those who don't follow the channel a lot, one thing I've been concerned about for a while is, a lot of the pre-construction condos that are closing and will be closing were bought at very elevated prices. And many of the people who would be taking possession, they would have sort of paid a certain price for their condos, but the condo wouldn't be worth what they paid for it. So maybe they paid $1,700 a square foot or $1,500 a square foot, but it's only worth $1,250 a square foot. So, values are about 20% less than what they paid for them. And typically in that situation, you have a huge problem because someone overpaid for the property. They have to come up with an extra 20% to cover, so basically, the deposit, because their deposit sort of covered the loss in value. Typically in that situation, you have a capital call, you got to cover the difference. So this, of course, has been a significant concern of mine, and it didn't materialize. And I mentioned to her because, again, I mean, of course, I can be wrong. Everyone can be wrong, and in particular in this case, I said I was wrong because I didn't really anticipate what Canadian banks would do. And I did a video of this and I kind of talked about this at the dinner. What Canadian banks are doing is effectively turning a blind eye to the fact that these condos that people are closing on are worth less than what they paid for them, and are not forcing these investors to come up with additional money to cover the loss in value. So they're in many cases, they're effectively getting 100% loan to value on their investments. And again, I did a video, I'm going to include it in the show notes below, where I talked about how many of the Canadian banks and also are effectively bailing out condo investors. And they're not doing this to bail out the mom and pop investor. They're doing this because many of the big banks have the debt to finance the construction on this project. And of course, if all of the unit owners don't close, it jeopardizes that project. It could lead to more systemic risks and fears about other projects failing. So there are broader macro reasons why they're doing this. It's not to necessarily just save the mom and pop investor. It's to keep house prices elevated, to prevent them from crashing, to prevent broader risks in the economy. So my takeaway was I didn't predict that. I didn't see that coming. You can't predict some of the things that governments will do to try to keep home prices going. I did not anticipate the Canadian government increasing the cap on insured mortgages to 1.5 million. I mean, that's kind of insane. I did a show on that. I think it's ludicrous. But again, I think this is all part of the agenda to, stimulate and drive home prices higher. To keep prices elevated the way our prime minister said they need to be. They don't want them to decline, and in fact, they want them to go a little bit higher. So I think these are some of the challenges when we make predictions. When I make predictions, you can't predict really what governments are going to do. You can't predict what people are going to do. You have to take everything with a grain of salt. But like I said earlier, when I talk about what I think is going to happen, I typically think about what is the most likely scenario given what we know today. Obviously, you cannot predict what's going to happen over the next 2 to 3 months. So I think part of this channel and everyone else's channel, of course, is for everybody to get all of the information and content they want. And of course, make a decision that sort of resonates with them, that sort of subscribes to their outlook as well for the market, the housing market, the economy in the months and year ahead, and to sort of make their real estate decisions based on that. Of course, obviously getting all the information possible. So those are my thoughts and brief takeaways on my Bank of Canada dinner. I hope you found that helpful. If you have any questions or comments, please post them below or shoot me an email at askjohn@movesmartly.com.